I think they'll choose the print every time. But let me just caution all who are listening to this. They could create a lot of pain before they do the big print. I mean, they could, they know that they're on the knife's edge of currency failure. And so they're going to possibly try and delay the big print as long as possible. I mean, we know the third Fed mandate is if something breaks, they will print money. We saw it in '08, we saw it in COVID. And so what I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. And at that point in time, the Fed will suddenly pivot and say, well, we're trying to fight inflation, but we can't let the system fall apart. And therefore, we need to reinstitute quantitative easing.
Bitcoin's recent performance has once again captured the attention of global investors. After months of consolidation, the leading cryptocurrency has broken out to new highs, with capital flowing not only into BTC but across the broader digital asset landscape. While some attribute the move to ETF inflows or speculative risk appetite, a more structural narrative is gaining traction, one rooted in macroeconomic fundamentals, deteriorating fiscal discipline, and a growing distrust in fiat-based systems. At the center of this narrative is Lawrence Lepard, an investment manager known for his deep understanding of monetary history and sound money principles. In this conversation, Lepard articulates a clear and compelling thesis. Bitcoin's rise is not an anomaly, but a rational response to a system defined by persistent debt expansion and the erosion of real yields. As governments around the world continue to finance deficits through monetary creation, Bitcoin's fixed supply makes it uniquely positioned to benefit from the long-term consequences of this policy trajectory. Lepard frames the current environment as a late-stage fiat regime, where inflation is no longer transitory, but embedded, where real assets are reasserting themselves, and where investors are beginning to hedge against systemic risk, not just cyclical downturns. He draws on both historical analogies and modern data to argue that the transition away from trust-based fiat systems is accelerating, and that the market is slowly repricing assets accordingly. For those managing capital in this environment, the implications are significant. As Lepard explains, what we're witnessing is not a short-term trade, but a generational reallocation of value, from paper promises to hard assets, from centrally controlled currencies to decentralized monetary networks. In the discussion ahead, we explore the key drivers behind this shift, why Bitcoin may be only in the early stages of a much larger repricing, and what that means for the broader economy, bond markets, and portfolio construction going forward. If you find this kind of analysis valuable, give it a like, share it with others, and subscribe for more insightful analysis. Don't forget to turn on notifications so you never miss an update. Every action helps boost the channel through the YouTube algorithm and supports our growth. Thanks for watching. Enjoy the video.
But why is Bitcoin going up now?
Well, a lot of reasons. I mean, the biggest picture, I think, is just continual monetary debasement. That's kind of, the book describes this as kind of just baked in the cake. This is Lynn's model, and it's been my model as well, that when you're expanding debt and you're expanding the monetary base more quickly than you're expanding GDP, that's an inflationary thing. And Bitcoin is fixed algorithmically to 21 million coins, so it will not expand as as all these other monetary base expand. So in dollar terms, Bitcoin, I'm with Saylor, Bitcoin is going much, much higher. It's going to multiple millions of dollars per coin over the next 10 to 15 years. So I'd say but to point to the biggest cause, it's because the fiat system and the Keynesian model really just kind of requires continued inflation. And there was a time when that was, calmer and people weren't paying attention to it, like the 80s, after we had the gold rush in the 70s, and then Volcker got things under control. And, most people weren't paying attention to sound money during the 80s. But, it's gotten steadily worse, this issue of government spending and debt. And I think now we're kind of at the point where the pot is really on the boil. It's happening very quickly now. And as we all know, we hit a record high price today, 109, and I see us going to 140 or 150 this year pretty easily, and potentially higher. But I'm very comfortable predicting that. I think the trade wars actually kind of feed into all of this. I think all of the economic problems that are bubbling up all over the place, including the Japan bond market, which appears to be kind of in a state of falling apart, I think all of these feed Bitcoin. the Bitcoin used to be the price used to be correlated with the S&P, or I'm sorry, with the triple Qs and the Nasdaq, because it was kind of viewed as a risk-on asset. And I think we're in the process of seeing that change. I think it's now starting to trade more like digital gold. And what's going on is these two assets are really beginning to realize that the government is in a trap, that they just cannot stop printing money to keep the system running. And once that becomes widely known and understood, we'll have kind of what I call and describe in the book as a mass scale Gresham's Law-like event where people want to get out of other assets, particularly bonds that are denominated in a fiat currency, and get into the two currencies that the government can't print, which are gold and Bitcoin. And I prefer Bitcoin to gold because it's got an adoption cycle and it's got so many advantages over gold. But I don't shit on gold. Gold's got merit. It got us all the way to 2008, and it's not going to disappear overnight. It'll still do a job of protecting some of your purchasing power, but Bitcoin's a much better choice.
For the folks at home, what is Gresham's Law?
Oh, sure. So Gresham's Law, Sir Thomas Gresham was a guy who was an advisor to Queen Elizabeth back in the 1500s. And what he said is, and so the issue of monetary debasement, this isn't new, right? This has been around for thousands of years. People have cheated on the money. The Romans clipped coins and sovereigns clipped coins, and everybody, the denarius, which is the Roman form of coin, was started off all silver. By the end, it was all iron. Um, and Gresham's Law says that people can figure out when the money is going bad, i.e., if that kind of debasement is taking place, the average human being will look at the money that they know is losing value, in other words, where prices are going up in that money, and say, and then they'll look at another form of money maybe that's not losing value, let's say an ounce of gold, and the price of something in an ounce of gold won't be moving at all, and they'll say, huh, I get it. This one form of money is losing value, this other form of money is holding value. I'm going to spend the one that's losing value because why wait around for it to lose more value? And I'm going to hold on to the one that holds its value, which is gold. And so the law itself is written down as good money drives or bad money drives out good. And what that means is that if the money is going, if one form, and there are always a couple forms of money going around in any economy, if one form of money is going bad, i.e., being debased, that will cause people to hoard the good money and spend the bad money. So, and at the extreme, like in Weimar Germany in 1921 through 23, they literally, throw out, the bad money and use wheelbarrows with which, because the printing presses were running so hot to purchase things, and they hang on to the good money, which in that time was gold or the dollar or the British pound.
As Bitcoin reaches new highs and gold quietly sets fresh records, the question savvy investors must ask is not just what is driving these moves, but why now? What are the underlying signals beneath the surface of daily price action that suggest the global financial system is approaching a turning point? According to Lawrence Lepard, the recent rise in hard assets is not simply a speculative cycle, it's a warning shot from the market itself. Investors are beginning to price in the consequences of unsustainable debt dynamics, negative real rates, and the limits of monetary policy as a tool of stability. Lepard argues that we're not merely in a bull run, we're witnessing the early phases of a fundamental revaluation of money. To understand the gravity of what's unfolding, Lepard turns our attention to a few critical macro indicators, leading signals that speak louder than any central banker's press conference. These aren't just data points, they're barometers of trust in the fiat system and early clues of the policy responses that may soon follow. In the next segment, he outlines the four most important charts he's watching right now, from the breakout in gold to the dislocation in long-duration bonds, and explains what they reveal about market expectations, government solvency, and the likelihood of further intervention by central banks. If you want to know where Bitcoin and the broader market are headed, Lepard suggests you start by watching what the bond market is saying and what policymakers may be forced to do next.
I think probably the most important macro indicator, well, there are 4 or 5 of them, but the price of gold. Notice it's hitting all-time record highs. A lot of people think, oh, it's just a bubble, it's going to come back down. No, it's not. It's going to go to 4,000, 5,000, ultimately 10,000 plus. The price of Bitcoin, same story. A few years ago it was 15,000, now it's at 109. I think it's going to 200, 400, 600 over time. The bond market, the long bond market, which tells you how much people trust that government bonds will hold their purchasing power. And what you're seeing there is in Japan, the 40-year bond is hitting record levels. In the United States, The 20-year bond just crossed the 5% mark, which is a big deal. And then probably finally, I would say, the stock market. The stock market's a little bit trickier to figure out, but it gives you a sense of how much liquidity is sloshing around in the system. And what I think is going to happen here is I think ultimately the stock market is going to start to go down. The U.S. bond market is already in the process of going down. Rates are going to go higher. And the U.S. government really cannot handle higher interest rates. I mean, we are currently spending about $1.2 trillion a year on interest in the U.S. It's bigger than the defense budget. It's approaching the Social Security budget. And if interest rates keep going up, the government's going to, go bankrupt. I mean, they already are bankrupt, but it's going to be worse and obvious. And so what I think will happen is the government will be forced into what I call yield curve control, which is another round of quantitative easing, which is really just complicated words for saying they're going to hit the button on the computer that says print more money. And that's fine. It'll keep the system going. But that's what they did in the COVID example when they grew money supply 40% in 2 years. And that's why everybody, I don't know about you, but when I go to the grocery store, I get horrified. I mean, the cost of groceries is just insane. I mean, it went up so much in the last 3, 4 years. It's been horrible. And so, and so I think we've got more of that in our future, sadly. I mean, yes, it's an everything bubble. So the reason it's a bubble and the reason we got to this point, and it's useful to discuss this, is that they kept interest rates at zero from 2008 to 2015. Remember, they had ZIRP, which stands for zero interest rate policy. They also kept them at zero from 2019 to 2022. And that created an enormous, enormous bubble because money was free. And so people borrowed and then they used it to lever up and buy yielding assets. Okay. Um, so the question of do we need it to burst for Bitcoin to go to new highs? It's unclear. I mean, if the Fed just pivots and starts printing money, no. But what I see is that we've got a Fed chairman who wants to be Paul Volcker, who's determined to correct the excesses of the COVID print. And so he's being very tough about not dropping rates quickly. And my sense is that what that's going to lead to is that something's going to break. I mean, we know the third Fed mandate is if something breaks, they will print money. We saw it in '08, we saw it in COVID. And so what I believe will happen is, the stock market or the bond market, one or the other, or perhaps even both, will quote unquote break. And at that point in time, the Fed will suddenly pivot and say, well, we're trying to fight inflation, but we can't let the system fall apart. And therefore, we need to reinstitute quantitative easing. We need to, use yield curve control to cap the interest rates on the bond market. And we stand ready to buy whatever bonds are being sold by the market. I think that's what we have in our future. Now, what's really tough, also, is just we don't know when that's going to happen. It could happen tomorrow. I mean, I can't see it happening taking more than 2 years, but I give it. It could happen. They could drag this out for a while. It could be 18 months or so before it happens. But I think what we do know because of the math is that it has to happen because without more money in the system, you don't have the capital to pay the interest on the growing bond balances. So it's really kind of a problem.
Is there any scenario where they don't print their way out of it?
I don't think so because I think eventually we'd enter the Great Depression, and I think that politicians presented with the ATMs aren't going to work and we're going to the Depression versus we are going to print to keep things running. I think they'll choose the print every time. But let me just caution all who are listening to this. They could create a lot of pain before they do the big print. I mean, they could, they know that they're on the knife's edge of currency failure. And so they're going to possibly try and delay the big print as long as possible. And, what would that look like? Well, I think if you go back and you study March of 2020, that's a good example of what it might look like. I mean, in that period when COVID hit, stock market went down 30%, gold went down 30%, Bitcoin went down 40 or 50%. Everything got hit because it was a trade correlation of 1 and liquidity was just way too scarce. And then, of course, what happened is on a Monday morning, Jerome Powell came in and announced, a laundry list of programs and said he's basically prepared to buy an unlimited amount of bonds, whatever it took to stabilize the financial markets. And of course, everything turned around very quickly. The stock market went back up, gold went back up, Bitcoin went back up, etc. So, but what that told me is that at some point in time, they were looking at the entire economy melting down. And you were younger, you weren't there, but I remember it quite well. I mean, in 2008, when that one happened, same idea, same event, although it was focused on housing and the banks. The not Jerome Powell, Hank Paulson went down to Washington, D.C. and was literally, on his knees begging to Nancy Pelosi and said, if you don't give us $700 billion for TARP, the ATMs aren't going to work tomorrow. And so Congress passed a bill, to give them $700 billion for TARP, which of course the Federal Reserve printed to do. So, I think that politicians backed against the wall, as bad as the inflation associated with the printing is, they'll view it as, well, we'll deal with that later, and I've got to keep the system running. That's so I think to answer your question, no, I don't think they'll let the system collapse. I mean, if they do, Bitcoin, gold, all these things aren't going to matter. You're going to want to have food and lead, I mean,
And
because
gun.
it'd be an ugly situation, I think.
As Lawrence Lepard makes clear, the current rally in Bitcoin and gold is more than just a speculative cycle. It's a signal of deeper structural imbalances across global financial markets. The growing weight of government debt, rising interest burdens, and the narrowing options available to central banks all point toward a future in which money printing becomes not just a choice, but a necessity. The market knows this, and increasingly, it's positioning ahead of the next phase. Nowhere is that positioning more evident than in the relentless demand for crypto ETFs. Not even the Memorial Day holiday could slow inflows. Bitcoin ETFs just posted their 9th consecutive day of net gains, pulling in $384.85 million in a single session. While funds like ARKB and GBTC saw minor outflows, BlackRock's IBIT ETF led the charge, attracting over $409 million, solidifying its role as the primary institutional gateway to Bitcoin exposure. Other ETFs like Grayscale's Bitcoin Mini Trust, VanEck's HODL, and Bitwise's BITB added meaningful support, driving total value traded to $3.9 billion and boosting total net assets to $132.89 billion. And it's not just Bitcoin. Ether ETFs extended their own rally, logging a 6th straight day of inflows, with $38.77 million added, led again by BlackRock and Fidelity. For serious investors, these flows are not just about short-term price action, they're about positioning for what comes next. As the pressure builds on monetary authorities to intervene once more, the market is already moving. Whether it's institutional allocations into Bitcoin ETFs, gold testing new highs, or bond yields breaking critical levels, the message is becoming unmistakable. The era of sound money alternatives is no longer hypothetical. It's accelerating, with or without a central bank pivot. If you found this video valuable, give it a like, share it with others, and subscribe for more insightful analysis. Don't forget to turn on notifications so you never miss an update. Every action helps boost the channel through the YouTube algorithm and supports our growth. Thanks for watching.